So which button would you press? Would you take the free $1 million? Would you take the 50% chance at $50 million? You guys know what channel you're on, so you know we're going to relate this to stock trading. What are the two big differences in stock trading rather than how it would pertain to just this simple question? One is that in stock trading, once you formulate a strategy, you can keep trading it, right? This question becomes clearly abundant if you would ask it, say, you get to hit one of these buttons 10 times, which button would you press? Very obviously, then you would press the green button, right? And then two, what's the differences in stock trading is that when you lose money, right? It's not just that you have a 50% chance to win 50 million. Well, what if you lose 40 million? Let's look at it from that direction too. We're going to look at expected value today. We're going to do some expected value calculations in order to define how you need to be trading your strategy in order to make money over time. Expected value is the most important concept I think you need to understand at the base of your trading philosophy. You must understand expected value, how it's calculated, and how you can utilize it in order to make money in the market before you will ever even understand a lot of the other conversations that you need to understand built on top of that foundation. Expected value is right there at the foundation of your trading psychology though. So hopefully you're excited for this conversation. Hit the like button if you are. Hit the red subscribe button if you're new so you don't miss out on any other stock trading videos on this channel. So as you can see here, we have the button question laid out, the 100% probability of making $1 million. Voila, if your expected value here is $1 million, you're going to make $1 million with this. But on the other hand, a 50% chance at $25 million, of course, also still not that difficult. Your expected value is $12.5 million on this side. But what did I say? One, let's start with this. One, you would obviously take the right side here in trading because you can do it over and over again. There's a little bit of a dilemma. Maybe you would take the left side, the red button, if you could only press the button once, because if your net worth is low enough, it actually might make sense to take the $1 million. It's such life-changing money. But we're looking at this from purely mathematical because it's not just one time in trading. That's why you need to understand expected value, because you're not going to win every trade. You don't even know if you're going to win your next trade. You have no control over whether or not you're going to win your next trade. What you have control over is whether or not you make money in your next 100 trades. And that understanding is the part of the foundation and where expected value comes in that you must understand if you're going to make it in trading. So let's go ahead and look. First off, let's do this. Let's add a $5 million loss, because what's the second part? What's the second difference in the initial question and stock trading is that when you're wrong, it's not just that nothing happens, but you lose money. So let's add a $5 million loss. You either hit the button, make 25 million, or hit the button and lose 50 million. Your expected value is still 10 million. This is looking at a 5-to-1 risk reward on a 50% win rate. Right now, we're going to start using stock words. Risk, reward, win rate. That is how you determine, excuse me, my voice is going away. I'm getting excited about this. That is how you determine the expected value of your strategy. It's not just win rate. It's not just how much money you make. It's the two of those combined over time gives you expected value. Now let's start to look. So what would this have to go to? What if we made it 15 million? 15 million at a so this is less than 2-to-1 risk versus reward, still profitable at 50%. But what if we made it what if you only won 30% of your trades, you lost 70% of your trades? This is now not a winning strategy. Now you're starting to see where this comes in. I don't care if when you win, you make 25 million and when you lose 15 million. If you're not winning at a high enough rate, it doesn't matter. I don't care how many trades you win, right? What if you won 90% of your trades, you only lost 10%, but in the 90%, let's say you only made 100,000. You only make 100,000 on your winners. If you win 90% of your trades at $100,000, but you lose 5 million, that's actually, funnily enough, still profitable. If you lose, I did not do negative 5 million. That makes a lot more sense. It's still not, I was like, how is that profitable? I forgot to put the negative number. It doesn't matter, right? You have to take both. the win percentage and the risk reward in your strategy. So what I want to do, I want to go ahead and pull over my stats. This is since June 6th. This is since I made the last change that I made to my algorithm. Been trading that now for about 2.5 months at this point, since June 6th. We're actually right at 100 trades, although I'm pretty sure I've taken more than that. I just don't think I split them all out in this, but it's still the same, whatever. We've won 67% of our trades. So let's go ahead and plug that in, a 67% win ratio. What does a win ratio imply? A win ratio implies that there's losers. A win ratio implies a loss ratio. You're not going to win all your trades. You need to understand that. You need to be comfortable with that. You need to be comfortable with losing, and you get comfortable with losing once you understand the expected value of your strategy. Once you understand that over time you make money. Look at this. My average winner, 34.58. My average loser, 45.82. My average loser is larger than my average winner. Oh my God, Trey, that's you're breaking the rules. You shouldn't do that. You can't do that, man. Your winners have to be bigger than your losers. They can't be, your losers can't be bigger. When I put this in, guess what? I expect to make money in my trades. My expected value of every trade I enter. So when I enter a trade, I know if I do it an infinite number of times that I've just made $8, slightly over $8 in that trade. Once again, only on 50 shares of SPY, but I've made $8 entering that trade in expected value. So the trade, as long as you get in and out exactly where you're supposed to, it's a good trade. It doesn't matter if it wins or loses. It doesn't. As long as you have proven the strategy works, you prove it through back testing and through journaling. If you take the trade, if you get in and out exactly where you're supposed to, it's good. Now, what if I let this slip? What if I started to let my winner or my losers run? What if I stopped stopping out where I was supposed to? All of a sudden, my average loser goes up to $65 instead of $48. Now it's a break-even strategy. It doesn't make money anymore. You can make it even a little bit more extreme just so this number goes red. If I start not sticking to my stop losses, this number goes up high enough, all of a sudden it doesn't work. Let's do the same thing the other direction. What if I start taking winners early? What if I only make, this needs to be negative, I keep doing that. What if I only make $20 in my winners instead of averaging the $34.58 that I'm supposed to? All of a sudden it's no longer a winning strategy anymore, right? That's why you have to get out where you're supposed to, not only on your losers, but also on your winners. You have to be getting the right amount of money in your winners too, or else that will throw off your expected value. That will throw off your edge. So hopefully this conversation makes sense. I don't need to drag it on for too long, but taking risk versus reward, taking the risk reward ratio, multiplying that by your win percentage, both of those things tied together. Once again, I don't care if you have a 90% win rate. You win 90% of your trades, you lose 2%. When you win, you make 100. When you lose, let's say you lose 5,000. Minus 5,000. I don't care, right? You're not a profitable trader. It's so important that the two of those work together. It's just like, I don't care if you make $5,000 in your wins, but you lose $1,000 on your losses. Say you lose $1,000 on your losses, you're only winning 15% of your trades, all of a sudden that doesn't work, right? I have a 5-to-1 risk reward. Okay, great. What's your win percentage? Understanding how important that the two of those tied together are and how that bakes into expected value. Just understand expected value over time and how important it is in that if you lose a trade, it doesn't matter. If you win a trade, it doesn't matter. It's all about what that expected value is. You should be worried about getting this number up. This is the most important number. I don't care average winner. I don't care about your win percentage. None of that matters. What's your expected value? Average trade gain loss. This is expected value. Get that number as high as you can. Get your profit factor as high as you can, right? These are the numbers that matter. So many people will flex. I mean, you'll see so many people flex giant P&Ls on Twitter. I don't care what your losers. How often do you make that much money versus your losers? It doesn't matter what you make in one day. Doesn't mean a damn thing. We're not in this to get rich tomorrow. We're in this to make it a career and to get financially free. And you must understand expected value to do that. So hopefully you enjoyed this video. Hopefully you enjoyed this conversation. Hopefully it helped teach you something. If it did, hit the like button. If you're new around here, please subscribe. With that being said, I'm going to go ahead and sign out of this video. I will catch you all in the next one.